quickly afterwards moved to the ECB and started to work there. I have you on my screen for several years meanwhile, so you are already for quite some time at the ECB, that's at least my perception. She's going to talk about public debt sustainability, so the floor is yours.
Yes, thank you, Lars, so much. And good morning, everybody. I would like just to start by thanking the organizer for inviting me, and also thanking them for the huge efforts they must have put into organizing this conference, in-person conference. As I was telling Lars yesterday, it's really so nice to have finally an in-person conference. I mean, it's my first after a long, long time, and it's definitely, it's different from the online ones. Actually, I was asked by organizers to discuss this topic of public debt sustainability analysis, recent developments and trends. It's a presentation with input from my colleague and co-author, Othman Bouabdallah here. We have contributed at developing the Eurosystem, ECB, debt sustainability analysis, and yeah, I will try to give some insights on this with the talk along these lines. First, to give you an overview of public debt sustainability frameworks in various institutions, but of course with emphasis on our own and some lessons that we have drawn from using this tool for many years, and then some recent trends for the Euro area countries. So, the sustainability analysis framework have come into discussion many times at the sovereign debt crisis, and now even more recently there have been recent calls to, for a stronger role of DSAs even in fiscal surveillance. There was the paper by Blanchard and Zettelmeier even proposing replacing numerical fiscal rules with so-called fiscal standards, having a debt sustainability analysis as a basis. A proposal, let's say, not necessarily to be endorsed by everybody, but in any case, this was, with such a proposal, DSA would gain even more importance. So in our view, actually, there is no simple rule for determining in practice whether government debt is sustainable or not. And that's why I think various institutions like the IMF, the Commission, the Eurosystem have comprehensive frameworks that are actually aiming at assessing risks, so risks to sovereign debt sustainability. And I think that Volker yesterday presented a bit of flavor of the framework of the Commission, which has also many elements from our framework, I will try to summarize a bit more what is in our framework. So, I mean, our tool is outlined more or less in an occasional ECB occasional paper from 2017, and it's a basis for the analysis conducted in the ECB and in the so-called Eurosystem Working Group on Public Finance, with experts from all central banks, national central banks, and we think it's a comprehensive framework on assessing sovereign debt sustainability risk. So for testing, stress testing in a sense, the debt, like sovereign debt. So our analysis is based on a harmonized ex-ante methodology. So we thought that this is important to be a methodology which is decided ex-ante, so not to have so much interference, ad hoc interference, and in this sense to also ensure consistency between countries and also transparent results across countries, so applying the same methodology to all the countries, but also of course taking into account their specific data and their specific characteristics. So it has a rich set of alternative scenarios which, as said, test the resilience of public debt to specific shocks. So we do not have positive and negative shocks. No, we have shocks that test the stress test the debt. So in this sense, more negative shocks. And it is a broad risk assessment, but we also think that it's important not to let these indicators, just different indicators pointing to different directions, but to also have an overall assessment of all this. So then to try to have a summary risk assessment and even in an explicit overall quantitative indicator. So in this way, so we have a DSA heat map, but also sustainability score. And in this way, we are able to track this evolution of debt over time. So we have even, a time series with how this assessment of the debt evolved and being updated at every forecast, Eurosystem forecast. And it's also free of judgment at the first stage, so this type of mechanical approach, free of judgment, and then of course some additional analysis, expert assessment can be added in various analyses on policy papers. So this is an overview of our framework, which has three main blocks. So one block is the what we call the deterministic DSA. So we have a benchmark, a baseline scenario, a central scenario around which various shocks are constructed. As I said, this is a mechanical, but we tried to have it as a plausible scenario to include as much endogeneity across variables as possible. We take the Eurosystem internal forecast for the given period of the forecast as an input, and then we extend this based on certain assumptions over a 10-year horizon. At the inception of this tool, we consider that since we have interest payments, for instance, based on market expectations, we consider that an internally consistent framework would also involve a fiscal rule that would not be necessarily a no fiscal policy change, as the government may react to, further to according to some fiscal rule to, let's say, increases in debt. And we have in this benchmark a fiscal rule based still on some minimum commitments according to the SGP. So not commitments according to the debt rule or much stricter, but a minimum required under the SGP, like some countries very gradually attaining their medium-term objectives. Then, of course, currently the discussion would be whether such a baseline is still realistic under current condition. Then, on top of this benchmark, we are also constructing various narrative scenarios. So, narrative shock scenarios, the one that you see here, which are considered and have been considered in various reviews as being relevant for stress testing this benchmark. And in addition to this deterministic block, we have a stochastic DSA. So as also mentioned yesterday, this was a tool that, for instance, Blanchard proposed to have it to be given much more importance in assessing the debt sustainability. So in comparison to this stress testing in the deterministic scenario, which is based on narrative, let's say, uncertainty about the macroeconomic path, shocks, the stochastic DSA is an empirical, so rather than a narrative analysis of the macroeconomic uncertainty. So in this framework, we think that our tool is also more advanced. We have here a Bayesian VAR, which includes the path of real growth, inflation, various interest rates, and so with this we are able to assess the uncertainty around these macroeconomic variables and construct the debt path in line with this uncertainty and some other assumptions that, okay, for the sake of time, I would not elaborate. And so in addition to this, we also have a set of other indicators that are considered to be important in assessing sustainability. And these are liquidity risks, so gross financing risks over the short term, market uncertainty and political risk, various indicators related to the debt structure, with, of course, understanding that countries with a shorter maturity may pose a higher risk in terms of this sustainability, and indicators related to the net financial positions of the economy, as was obvious in the sovereign debt, or before the sovereign debt crisis. These private and external imbalances have been very relevant in some of the countries under stress. And we also have an indicator related to contingent liabilities, so other than the purely budget position of the liabilities of the general government budget. And of course, as mentioned also before, a very important part would be the quality of institution and governance, on which we also have several indicators. So these are some of these are just externally taken, like for instance political risk, quality of institution and governance taken from other institutions and as exogenously in our framework. So then with all these indicators, we would need to evaluate them based on certain criteria. So for the deterministic DSA, the evaluation in our framework refers to three main components. So it's the level of the level of debt. So countries at the end of the forecast horizon having a high level of debt under various thresholds would be, let's say, penalized in this assessment framework. And we tried also over years to smooth in a non-linear way around these thresholds, so not to have very big threshold effects in the assessment over time. And another component is the dynamics of debt. So we look in terms of dynamics, how this debt path stabilize and decline. And at a year of stabilization, so the longer in the future, based on the uncertain forecast this year is, or the flatter the slope of the debt path, let's say the higher penalty in this type of assessment. In the benchmark only, we have an additional criterion, which is the fiscal fatigue, meaning in this HGP-based fiscal rule, how much fiscal effort is involved, and comparing this fiscal effort with the effort done by the countries in the past. If what we consider in the benchmark is way out of the ranges that countries have implemented in the past, that this is also considered a risk. For the stochastic DSA part, we are looking at the dispersion of the fan charts. So a higher dispersion would mean much more uncertainty around this debt path, but also the probability of the debt being above a certain threshold, so 90% or not stable. So out of the 20,000 debt path that we simulate, we take the share of the path in which the debt would be above 90% or the debt would be not stabilizing. And so countries with a higher such shares are also considered in this assessment as being more risky. And for all the other indicators, we look at thresholds from the literature, so various other analyses. Now here we rely on some analysis from the IMF on specific threshold for some of these indicators, like debt thresholds or liquidity, gross financing needs, and where such thresholds are not available on percentiles. So simply like the first, the 33rd, upper percentile in terms of like good results of these countries would receive a better score. And then all this, based on a weighting scheme, we are putting together in a kind of sustainability score that, as said, we are able to track over time to see not only the level, but also the changes in this assessment over time, depending on data. And I mean, from applying this method over time, we also draw some conclusion that let's say that before these frameworks also of the IMF, of the Commission, ours were implemented, debt dynamics was the only indicators that counted. Now, if the debt is just on a declining path. But we also think that the level it's important, so the level at which the debt stabilizes, and this should be kept in any of such debt sustainability assessment. So, because it's, so the experience, also the literatures have pointed that high debt countries on average seem to be actually take longer to stabilize the debt, even in an environment of negative interest rate growth differential. Here I depicted the debt path outcomes compared to the forecast. And in the high debt countries, and here this is a GDP weighted average of the countries with debt before the crisis, the pandemic. So in 2019, higher than 90%, and the rest low and medium debt countries, so the rest of the euro area aggregate. So in the high debt countries, so few conclusions from here. I mean, the high debt countries took over this period, 2013-19, which was a relatively favorable, also with low interest rates, negative interest rate growth differential. As of 2015, these countries have barely stabilized their debt, while in the low debt countries there was a large reduction in the debt. Then, compared to the forecast, these countries, seem to have, the high debt countries seem to have had always a higher debt than the forecast. So basically the dark line is the outcome, as in the latest Commission forecast, while the thin lines are the various Commission forecasted, the various vintages. While in the low debt countries, they seem that the debt has actually been below this forecast over this period of time. I mean, a positive aspect, another aspect is that, of course, in crisis, the high debt countries tend to have a higher increase in debt. Okay, this crisis, the COVID has been particularly, some of the high debt countries happen to be more affected by the pandemic, but this is still a general feature that due to the sovereign risk channel effect, the increase of debt in terms of crisis is higher in these countries. A positive effect is that a positive recent feature is that these countries have reduced now, in at least in the first year after the pandemic, more the debt compared to the other, and it's also much better outcome compared to what was estimated at the beginning. But in any case, we are still thinking that relying only on dynamics and not taking the debt level into account may be also an incomplete assessment and more prone to errors. And then in this context, some empirical and model-based analysis that we concluded together with other colleagues. Here also some references. We would still draw the conclusion that the high debt levels in general tend to face higher interest rate growth differential. So this is based on a paper that I have also conducted, in which we control for many other factors affecting interest rate growth differential, but continuously, the higher the change in the debt and the level of debt was still associated with this higher interest rate growth differential. These countries have less scope for counter-cyclical fiscal policies, so lower multipliers in these models. They face crowding out of private debt in the short and long run, and they tend to lose, they tend to record higher output losses, lose more output in terms of crisis, as said, and be adversely affected in terms of potential output. But we must say that indeed, especially in a paper that we conducted with 3 large-scale DSG models across 3 participating central banks, this reaction also depends this outcome depends very much also on the monetary policy reaction. So monetary policy being accommodative, it lowers the spread channel and can prevent some self-fulfilling crisis, especially when the factors may be really, in terms of contagions outside the scope of control of some countries. So in this case, the appropriate fiscal monetary interaction is still of essence, particularly in times of crisis. So this is only just to illustrate a bit this idea that level of debt is important for interest rate growth differential. So I personally do not endorse so much this idea that interest rate growth differentials over longer periods of time have been negative. I think that actually is more evidence to that over the long term in advanced mature economies, so not emerging economies catching up in the development process, interest rate growth differentials have been positive. This is some evidence for the US, for Japan, for the advanced euro area economies from the 70s, for the US even now with the high inflation, but then much more, of course, from 85, but also for the euro area period. So as we can see here, on average, the differentials have been positive and more and higher in the high debt countries. And as of 2015, the euro area started, aggregate differential started to be negative. And in this right-hand side chart, we also calculated the interest rate growth differential based on market expectations in the latest, based on our latest forecast now in June projections 2022, and it's clear that this the curve has shifted up compared to almost 1 year before, and it's approaching positive. It's still in negative territory, especially for the high debt for the low debt countries, but here a feature is that this assumes no crisis, no shock over these 10 years. It's just real growth tending to potential and taking market expectations. But we have seen that every of these shocks tends to increase differential significantly, so the average could also, in principle, be closer to some historical. So. Of this, based on this application of our DSA tools, we think that two components are very important in this analysis. So it's the potential growth, which really plays a major role in the sustainability assessment in these shock scenarios, because it determines the growth over the long term. But not only this, it's also the fiscal effort that these countries, and especially the high debt countries, have to put in. But indeed, potential growth is very important, not only for the real growth path over the long term, but also for structural fiscal positions which depend on this potential growth. So in this case, this initiative of NGU has been instrumental in a sense too, and is expected to play a sizable role in high debt countries in terms of promoting structural reforms and also having lowered risk premia compared to the moment before announcement of the NGU. So in terms of debt sustainability analysis is assessed, like for countries like Italy and Spain, to have a higher impact. So again, potential growth is important, but we think that other variables like the fiscal effort is also important. So here we, a bit in line with what Volker also showed yesterday, conducted some scenarios based on the benchmark which embeds all the recent macroeconomic forecasts from June 22 of the euro system, and we took a shock of 1 percentage point of interest rates for the sake of illustration. Only in this case, the same shock for the low versus high debt countries, although it's could be very clear that in the case of turmoil, the shock and the sovereign spreads would feed more into the high debt countries. But we wanted to point that still it's no fiscal policy change, so the lack of additional fiscal effort over a medium term. I mean, we are talking about some additional adjustment after the end of our forecast, so after 24. I mean, the lack of such adjustment would really put some debt over an increasing path, and more so in the high debt countries. And again, to make again the point that you know, the level matters. The charts look similar, but the axis is still important because in this case, over a 10-year horizon, the debt would just go somewhere close to 60% in the low debt countries, but much higher in the high debt countries. So again, more or less, this fiscal effort is still important in addition to the potential. So, I mean, I would conclude now, for the sake of time, that by again mentioning that in our experience, we think that it's difficult for determining just super precisely whether a government debt is in practice sustainable or not. And then, so various institutions have comprehensive frameworks trying to assess risks to sovereign debt sustainability. And given the sensitivity of this topic, one really needs to find a fine balance between having an ex-ante decided framework and country-specific judgment. Since there could be country-specific characteristics at a certain point which are still not captured in this ex-ante framework. On the other hand, having a framework that is decided ex-ante and without possibility of interfering ex post is also very important in our view. And yeah, we are also seeing that different shocks and crises may deserve indeed inducing some changes in the framework, so some regular revisions of the framework. And here country judgment would need to complement the standard framework, but as long as really capturing accurately specific country conditions and not other type of considerations. And would conclude by recalling that debt level, potential growth, and counter-cyclical fiscal efforts, we think that they are essential ingredients in DSAs, and all these are reinforced really by appropriate monetary fiscal policy interaction. Thank you.
Thank you very much, Cristina. So the second speaker today in this first session of the morning is going to be Xavier Debrun. And I think you have slides, and the slides are...
I have slides.
There should be on this... Are they? Hopefully. While you are looking for that, I'm going to say a few words about Xavier. Xavier is still with the Belgian National Bank. He is a member of the board of the European Fiscal Board. He has taught at several universities. His degree is from the Credit Institute in Geneva. He holds a PhD from there after studying as well. He was with the IMF, with the Fiscal Affairs Department for many, many years, I think over 10 years, something like that. And so we are looking forward to your presentation. I'm sure you know Xavier from several publications regarding fiscal councils and so on. So, Xavier, it's your time. Go ahead.
Thank you so much, Lars, and thank you for the invitation. I'm sorry I couldn't be there yesterday, but the train company decided otherwise. So at least I take some comfort in the fact that it was a low carbon trip from Brussels. Okay, so I'm very happy to discuss again a paper by Cristina, because I think this is the second occasion I have to discuss a similar presentation by you, and of course I think that everything you say I practically agree with it. So I'm going to try to entertain you a little bit around the topic of public debt sustainability. I'll just say a few words about the presentation of Cristina. But you know, if you go back to basics, essentially debt sustainability has to do with solvency of the government. And the solvency condition is simply that your debt at a given point in time should not exceed the complicated thing you have on the right, which is the net present value of all the future primary surpluses that you can expect to generate, or the future primary balances. You know, if R is negative, what is R? R is basically, if you consider that the little d on the left is the debt to GDP ratio, the big R is essentially R minus G, so the difference between interest rates and growth. And so essentially solvency is telling us that, you know, at the very end of the world, there should be no terminal debt. And from the debt accumulation equation, you can derive this thing that we call the intertemporal budget constraint. And as Cristina reminded us, R is usually positive, so there is a positive differential between interest rates and growth. And this is why the topic of debt sustainability and solvency is interesting. At some point, governments need to generate primary surpluses. Now, if you look at this condition, you say, well, basically what I have to do is to figure out whether that complicated thing on the right is actually sufficiently high, and that complicated thing on the right is entirely about the future. It's totally forward-looking, okay? So when I told my thesis advisor, since you reminded me of my PhD time, Charles Wiploch, he told me, oh, you know, Xavier, this is mission impossible. Okay, mission impossible. We cannot predict the future. Debt sustainability is not for serious economists. I say, okay, well, tough luck, Charles, but you know, I'm at the IMF now. I was then, and I have to work on this thing. And therefore, we got to be pragmatic as practitioners. Okay, we're PhD economists, but we need to be pragmatic because our political masters or our bosses expect something. And so essentially being pragmatic has meant, well, we don't want the debt to GDP ratio to be on an explosive path. That's essentially the definition of public debt sustainability. And there we have two key equations. The first equation is the standard debt accumulation equation that Cristina reminded us of, which is that the variation in debt depends on the initial stock of debt. You have this magical R minus G factor, obviously, and of course you have P, which is the primary surplus, the primary balance, which is the contribution of annual fiscal policy to a debt accumulation. And the second thing is, in my view, the key part. Because, you know, the first equation is just arithmetic, okay? My 10-year-old daughter can get that. But the second part is the key. This is the, she's very smart. No, I'm kidding. Anyway. No, essentially that's the policy behavior, that's the policy rule. I mean, how is today's current, primary balance going to evolve as a result of what it was in the past and what the debt was in the past? I mean, to what extent does the government systematically respond to the debt level? Okay? And that is captured by this little Greek letter, rho. Okay? Sort of overcooked spaghetti, okay, before the tea. So, in any case, debt sustainability is ensured if, on average, your rho, that is your fiscal behavior in response to debt, is actually larger than your R minus G. That's how debt is going to be mean reverting. Otherwise, it's not going to be mean reverting and you're in trouble. So, fiscal behavior is really the key. Is your government systematically responding to past debt in a way that is consistent with a stable debt trajectory? So at the end of the day, since you're looking at a politician and trying to guess what he or she is going to do in the future, you have to conclude that debt sustainability is not a technical exercise. It is an informed judgment on government's ability to avoid bad ways of meeting the intertemporal budget constraint. Because let's not forget about that. Ex post, solvency is always fulfilled. The solvency condition is always fulfilled. There are good and bad ways to fulfill solvency. You can default, you can restructure, you can rely on inflation. These are bad ways to meet your budget constraint, but they exist. and countries do it. Okay? So you really want to figure out with the DSA whether your government is going to be capable or able of avoiding these barriers. So in the real world, well, this is essentially what Cristina talked about, so I'm not going to elaborate too much about that. I'll just note two recent trends in the debt sustainability frameworks that we use at the IMF or they use at the ECB. I still say we when, okay, I'm not at the IMF anymore, but that's okay. You got it. And so it's a greater complexity. We tend to rely on those fan charts, heat maps. We really try to figure out what a battery of indicators are telling us. Then we try to aggregate those indicators and come up with a magic number, and so on and so forth. We also try to rely on early warnings indicators and so on and so forth. So there is a trend towards a greater complexity. And this carries some risks for economists who are interested in that and for certainly practitioners. The first risk is that we tend to be, or we could be, overwhelmed by the number, the fuzziness and the complexity of the relevant considerations. Oh my God, everything matters for that sustainability. And so my plea here is for the practitioners of DSA, to resist the urge to be as holistic, non-linear, stochastic, general equilibrium, whatever, as possible. Okay? Let's try to resist that urge, because at the end of the day, your DSA is going to become a black box. And so it's going to become complicated for you to explain what happens in the black box. And people will look at it and say, what? Okay, so what? Okay, this is the so what question. And having done many, many missions where I had to explain on behalf of the IMF the result of the DSA, the so what, I got it many times from politicians. And our DSA was quite simple. So you have to understand that I was referring to some of my official counterparts when I was at the fund. The key stakeholders that you face when you explain a DSA usually have a limited public financial details. Okay? There are voters, there are small investors, taxpayers, sometimes even country officials. So there is value to the simplicity and the transparency of the sustainability assessment. Okay, so let's beware of the black box. My views on Cristina's presentation now, I basically agree with everything she said, so thank you for that. This is state of the art. I have one caveat and one thought. The caveat is fiscal behavior. I mean, she explained to us that indeed they look at empirical aspects of fiscal behavior and that it certainly matters. But I also saw, or I feel at least, but maybe she can clarify that some heavy reliance on fiscal rules, that the fiscal rules somehow that are in the SGP are broadly respected and so on and so forth. And fiscal slippages are just a risk factor if I understood it properly. My plea here would be to rely solely on empirical patterns of fiscal behavior. We saw earlier it's absolutely critical to get that right. And I would look at the past. This is the only thing we have to predict the future. And really focus on empirical patterns. Let's not forget that on average, the compliance rate with European fiscal rules, or with fiscal rules in general anywhere in the world, is in around 50%. So half of the time you don't respect your fiscal. So it's not just a risk factor. So at the end of the day, again, it's a judgment. And if it is a judgment, we have to wonder about what I would call the political economy of DSA. I mean, I've been in that business for many years, and I can tell you, 2003, yeah, and I can tell you that it's very, very easy to reverse engineer any given conclusion about that sustainability with rather small tweaks in the parameters, especially if you focus on the long run indicators. And if you look at the famous S2 indicator of the Commission, a tiny weeny pension reform that changes a little bit the thing, and boom, you're home. Okay? It's very easy to reverse engineer. The last DSA I had to officially review at the IMF was Argentina 2018. Very easy. Okay, so in my view, I forgot to say, of course, I'm speaking in my own. So nothing to do with the National Bank of Belgium and the European Fiscal Board. So only politically independent institutions should provide official DSAs, in my view. Independent fiscal institutions, for sure, they should do it. That should be one of their key mandates. Central banks, probably. Well, I agree. You have a job in doing DSAs at the ECB. The European Commission, probably not. It's a political institution. And reverse engineering is so easy. So to conclude, two issues that I think are making DSA even more important, but also even trickier today than in the past. The first is the ghost of the EU governance reform, which keeps being promised and being delayed. I've done a little exercise which is still in my drawer. I haven't published it yet, but it's basically, we took a look with a European Commission colleague at the number of proposals for reforming the fiscal rules of the Stability and Growth Pact, and essentially the horizontal bars are telling you the number of proposals, which is the vertical axis. And you see that recently you had between 20 and 25 proposals a year, so it's a growth industry. You can always come up with your own little proposal to change the pact. And what is interesting there is this gray bar here. I mean, a lot of those recent proposals are actually considering that having a debt anchor is essential. They remember that fiscal rules are about debt sustainability at the end of the day, and they say, okay, we want to simplify that. Let's go back to basics and let's make sure that the fundamental parameter at the core of the rule is the debt. So debt sustainability again has a great future, and maybe even trickier now. A year ago, I was actually talking about that sustainability at a seminar at the OECD, and I was pretty desperate because I said, well, with R minus G negative forever, no inflation in sight, that money, what's the difference anyway? And so it's very difficult to conceptualize that sustainability analysis. And now I feel much more comfortable to talk about that sustainability, especially when you look at that chart, which is the daily not spreads, but the daily yields on 10-year government bond yields for a bunch of countries. You have Germany and its main neighbors, and Belgium, and its main neighbors. And what you see essentially is that it's going up since December. So between December and now it's even higher. It's 2.3 now, I think. You see that yields have been going up. There was a little dip after Mr. Putin decided that Ukraine was part of his kingdom, but otherwise the only way is up. And not only that, but you see, of course, what Cristina mentioned, which is that when you have monetary policy tightening, it's not happening yet, but it's already happening in the sovereign debt market, you see that, of course, the spreads are also widening. It's unavoidable. There is a decompression of those risk premia. And this is an issue when you are in an incomplete monetary union. Incomplete meaning that you have many treasuries and one central bank. Because effectively the ECB has the unpleasant task now to try to differentiate between what is a fundamental debt sustainability issue and a non-fundamental. And by fundamental, I go back to this judgment. Are we in a situation where there is no realistic fiscal policy that can stabilize debt under plausible macroeconomic conditions? Okay? If there is no such fiscal policy, then you have a fundamental problem and you need to think about restructuring, you need to think about defaulting. It's not an option here. So, if in that context the ECB DSA remains very attached to rules compliance, and I hope it's not so as attached as I think, then effectively I fear that we could be on a slippery road where the ECB would slowly but surely become the enforcer of the fiscal rule, which is a fundamental fundamentally political rule. And if it doesn't want to go there, and I don't think it should, then it might be tempted to delegate that to the European Commission. That is, I'm going to do things on the sovereign debt market if the European Commission decides it's right to do so. Wow. So if you link, these efforts by the ECB to try to stabilize and to distinguish between fundamental and non-fundamental fiscal problems, if you delegate that to the European Commission, basically you end up telling the European Commission, look, you have to decide whether I'm going to stabilize the market of a country, or the sovereign debt market of a country, or not. Therefore, that means what? You're telling the Commission your excessive deficit procedure now is a nuclear option. And politicians don't usually use nuclear options. So you basically kill the excessive deficit procedure. Is this where we want to go? I don't think so. And this is a slippery path. I hope I'm completely wrong in what I'm saying, that nobody's thinking about that. But I must admit that the thought crossed my mind recently. Thank you so much, and enjoy the rest of this conference.
Thank you very much, Xavier, for this serene view on debt sustainability with all your experience in the past. Our next speaker is going to be Christian from the University of Bonn. But he's coming forward now. Christian studied at Bonn and finished his PhD at the University of Dortmund, and then moved back to Bonn as professor several years ago. He has written extensively on macroeconomic issues, in particular on fiscal policy in a macroeconomic sense. More recently, he became world famous with a paper where he, with co-authors, simulated, calculated, forecasted the effect of a full energy embargo to Russia on the development of the German economy, and also made it to the mind of Chancellor Scholz, saying how these economists are always speculating different things. He was even a bit more on the point than I do. So we are very happy that you are here. Christian, the floor is yours. I just spoke a bit longer until the...
Thanks a lot, Lars. Thanks a lot for having me discussing this paper. Thanks for this conference. So this is, I think it's timely to think about debt sustainability. This is not Europe, this is the US. So debt levels are rising, and potentially that might be an issue for the world economy. And that might have also spillovers for debt sustainability in other countries. I'll come to that as I go. So the paper is a very nice, or the presentation was a very nice overview of the tools used by administrations, in particular the ECB, not focusing on a single approach, but an area of indicators. Both levels of debt and surpluses are of course important in debt sustainability analysis, and of course we all know that there is an important role of interest rate levels. So I try to summarize what, in my view, the presentation said about the situation. Maybe I got it wrong, but it looked a bit like, well, after all, it's not so bad, because basically growth will eventually take care of everything that is there. We've seen these figures for Spain and for Italy, where the extra debt that's taken on by Next Generation EU, that will be taken care of through structural reforms and risk premia, and also by some fiscal multipliers that are quite substantial. So that might be true. So maybe it was an ingenious idea to spend a large part of NGEU on thermal insulation of houses. This pays off this year. So maybe that's all true. Now, I want to make 3 remarks kind of from the academic point of view. Maybe it's a little bit theoretical. I hope I don't bore you too much with that. So the first thing is looking at debt sustainability. We've seen that kind of equation. I added a little extra. I added a little extra thing here, the price level. to turn this analysis into FTPL. So you've got primary deficits or primary surpluses in the future. You discount them. For simplicity, I just put one interest rate here. That's constant over time, and I'll talk about that. Just makes the formula easier. And then you have the nominal value of public debt that is outstanding here and the price level. So whenever something changes on the right-hand side, something needs to change on the left-hand side. The outstanding nominal debt that you enter this period cannot change, so the price level has to change. So that's basically fiscal theory of the price level. Now there are some interesting and funny things that can happen, in particular at low interest rates. So at low interest rates, what really matters is the far future, and Xavier talked about that. So what we assume what will happen to primary deficits and surpluses some 100 years in the future, that matters most, that matters heavily for what we think whether the debt is sustainable. So that's like a political economy problem, but it's also sort of for the decision makers that will actually live in such an economy, and they have to take expectations, a difficult thing. The other thing is, well, this is a infinite order polynomial, and they do have funny behaviors because they don't need to be monotone in changes in R. So this is another kind of little bit theoretical observation, that if the real interest rate changes, it's not clear in which direction this goes, right? Because it's only clear if you have always positive primary surpluses, for example, then it's clear. If they are all monotone, then that's clear. So you can have that the interest rate rises, and you can have a sharp rise in the present value of this sum here, or you can have basically that nothing happens if interest rates rise, depending on when you are planning for the fiscal surpluses to actually occur. The other thing is, we've seen that that's what Cristina was showing us. The projections are that the interest rate growth difference is negative. It's going to stay negative. That's what the data seems to suggest. So does that mean that any debt level is sustainable? I want to argue on the next slides it's not. So another point is, which I will also try to tell you a little bit about, is that of course it matters what we do spend the debt. So for simplicity, I'm going to look at something like a sovereign wealth fund that's debt finance. And there, higher debt levels, of course, are much more sustainable. So potentially this needs to play a larger role also in the sustainability analysis of debt, or at least when it comes to policy rules, thinking about how we should deal with debt. Okay, so I will use the last minutes for shameless self-advertisement and talk a little bit about my own paper with Benjamin Bourne and Ralph. So what we look at in this paper, and I think it has to say something about sustainability also of debt, is how returns on different assets change after fiscal expansion. So what you see is for the US, and we show that also for an international sample, that after like an increase in fiscal spending, the real interest rate, the real bond yield goes up. But the returns on other assets, on capital, on housing, on corporate bonds, does not move one for one, so that a premium, the premium that these assets have over government bonds, they shrink when there is more ample supply of government bonds. Okay, what we then do is we try to understand this in a framework with heterogeneous agents where government bonds play a productive role because households use them to self-insure. They are very liquid. They're good for the banking sector if you want. The banking sector can produce deposits with that. So households like that because they can smooth consumption. So we can use that model first to check whether it can generate the data that we observe, and we find estimating the model by IRF matching that it does. It matches the movements in the real interest rate and the premium, but then what we can do is with that is a counterfactual analysis where we increase the government debt target by 10 percentage points and ask how that how the economy will adjust over time to that, and what this will do kind of in the long run. What we get is that an increase in public debt, and here for simplicity it is all paid out by transfers over time. This will increase, so the black line is the one you want to focus on. This will increase here the nominal rate and the real rate. This will decrease the difference in the return on capital and the return on government bonds. And it will lower the capital stock, but not so much, and that's the blue line, compared to a situation that you might think through when capital bonds are the same thing. So what we find is that the elasticity of the liquidity premium is similarly, basically, you think of the same elasticity as the elasticity of the real rate to the level of government debt. It's like 2.5%. Now, why is that important? I mean, this is important first because if you consider a sovereign wealth fund as, instead of paying this out in transfers, such that the capital stock goes up, then given the return difference that we observe between capital and bonds, this becomes self-financing for the government, despite the fact that the interest rates the government is paying are increasing. Now, that fact that the interest rates are increasing for the government is important for this I minus G discussion in the sense of whether government debt is cheap. Because this increase in the interest rate on government debt that you have when you increase government debt increases the fiscal burden of outstanding government debt. So actually, government debt on the margin is much more expensive for the government than just the I minus G difference. So you can do a little bit of calculus with that, but you can also put this in a simple graph. So what you get out from the model as a prediction is that the interest rate that the government needs to pay on debt, that's increasing in the debt level. So that's on the right-hand side. And the debt burden has this funny shape. If you have zero debt, the debt burden is zero, of course. But now, because the interest rate growth difference is negative at very low levels of government debt, having small, but still existing, levels of government debt gives you a continuous negative debt burden, a continuous contribution of rolling over the debt to the household of the government. Now, if the debt level increases further, at some point the interest rate becomes positive, and you actually have a positive burden of government debt. Now, what you see here in this graph is our estimate for kind of the historical post-war period and the more recent period. Interest rates have gone down. The demand for liquidity by the private sector has been particularly high. And for the US, we estimated that any debt level below 50% of GDP, that sounds ridiculously low for the US right now, would be inefficient from a fiscal point of view. So you have lower debt levels, so less liquidity provided to the private sector, but also lower revenues for the government, so the government needs to raise more taxes to finance its budget. Now, if you increase the steady state debt level, you can lower taxes persistently and just roll over more debt. As you increase the debt again, you will need to raise taxes, but you also provide more liquidity to the private sector. So our estimate for the US to be permanently at a real interest rate growth difference of zero would require a debt level of 160% of government debt relative to output. So that's still higher than today. The question is where the real interest rate, where these real interest rate changes that we've seen are coming from. Are they coming from a reversal of this outward shift of this curve, or just from the higher debt levels that have been accumulated through the pandemic? And my hunch is it's both, and both plays a role for the understanding of the sustainability of debt and government budgets. So let me conclude. I think the presentation was a great overview of the tools used in debt sustainability analysis. The question mark that I want to add is whether we should treat interest rates as exogenous to the level of government debt, whether we should understand them importantly as a function of government debt and take that into account when we think about the fiscal consequences of government debt. When we should not worry a little bit more also on what deficits are actually spent for. I'll conclude with that. Thanks a lot.
Thank you very much. So we start a little bit later. We have more time for questions, if you like, and for discussions. And I think that the three people giving presentations would like to discuss as well. I'm going to come to you.
Yeah, I mean, I really like both the presentation and the discussion. I mean, 2 points. Well, one, of course, that what matters is not the average rate, but is the marginal rate, which I guess is another point. And this is possibly dependent on the level of debt. But the second point, I wanted to return to something I said yesterday, that in an inefficient economy, the interest rate that we use for sustainability is, there is not just one interest rate. The reason why for decades we had that R was less than G is because the return of capital was actually higher than the safe rate. And so there is that wedge, which is a safety premium, which we have enjoyed for a long time. And the question is whether we will continue to enjoy this safety premium. And the safety premium is endogenous policy. And so that's the old question of what do we do with that. And how robust is the framework that we have in Europe so that we will be able to guarantee this form of synergy that the government enjoys or not. And this is the role of the central bank and so on, and what we discussed yesterday. I think this is a very important point because when we say R, in the standard economic model, that R is the marginal product of capital, but in reality we know that this has not been the case. And so, and this means something, and this is the whole issue of safety.
Just for the replies, I'm going to save some time.
Thank you very much. I have to say that I very much like the presentations. It's a state of the art, and it's a good idea to concentrate on issues that can be treated in a manner that is structural. And we know nobody is perfect, but it's an elaborated version. So congratulations for that. I would comment on 3 issues concerning the presentation of Cristina. Normally we use these tools for ex-ante analysis, but it can also be used for ex-post analysis. So what I would like to ask is, what has been the impact of QE and the ultra-low policy rate for the last 10 years of the very high indebted countries in the euro area? And the picture, I say what presentation, page 5 or 6 of the presentation show that there was no impact at all. So the effectiveness of these measures concerning the sustainability of the high indebted countries is very important, and what you say there is, at least, if you look at the figures, there is no impact at all. In the low indebted countries, there is a sharp reduction, but not in the high indebted ones. So this gives me to the second question. Should we consider that there is a relation between the interest rate and the primary deficit? So I would argue that there might be a connection that the lower the interest rate, there is a positive response from the public side. So in that respect, I would say there is a relation that seems to be underrated so far in this analysis. And the second one is, what is the role of a higher interest rate on fiscal sustainability? This is a very relevant issue. And what these pictures say and the analysis say, it's partial equilibrium, of course. So we should be very cautious, but I think some answers should be given and the do's and the don'ts, and what we know, we do not know, should be also be relevant to know. And the last one is about R and G constellation. If R is lower than G, so what should we do with our calculations? Should we go home and leave it aside, or should we take the challenge and to say, normally in a dynamic, efficient economy, there is good reason to say that R is higher than G, and that should be the guideline for longer term considerations. And there is also in the ECB the feeling I have is that the interest rate also has a positive impact, or an active impact, let me say that, on the growth rate. So, in the medium term at least, it is not so easy what is exogenous and what should follow whom. In that respect, I would say, no, it is not exogenous. And the last issue is there are a lot of indicators you can choose. So we should test it. And the best test is the market test. It has nothing to do with fragmentation issues. Let me give the judgment of the markets, and we will see whether there is a sustainability problem or not. So it is supplementary to your analysis, but if somebody should know, then the markets will have a good feeling to give you an impression. Thank you.
Well, actually, I would make comments as well, but I give the presenters the opportunity to reply. Cecilia, would you like to start first? It's good.
Yeah, no, thank you for the nice words, but also for the very good comments. So maybe, Xavier, just to mention that, yeah, we will send some of your nice messages back to the ECB, I think. So this is some of them are very also challenging, but a lot of food for thought. I mean, just to mention a bit regarding what you said, that we are not looking too deeply into the primary balances that we assume now as this SGB route. We try to do this in these indicators that we told you about the fiscal fatigue. So we do look into what countries we assume for consolidation efforts over this period, and we compare to what countries have done in their past. So this is still like a country-specific analysis, trying to put these two elements together, also based on the fiscal reaction functions. You worked on it. I also had some papers on it. So we are trying to look also in terms of an empirical analysis how countries have reacted in the past. So we put this analysis in regard. Okay, I mean also with your comment that indeed some analysis is too complex and no, difficult to explain. Yeah, we also sometimes are confronted with this, but then at least we know the framework, and we are able to say from where a certain change comes mostly. Does it come from changes in macro variables or fiscal, or so we can still explain. So going back to your comments, Christian. So I think it's well, thanks for saying that it was a nice overview, but I think some of the main messages were still maybe not well captured, because it was not my intention to say that in the euro area everything is just very easily solved by growth. So it's not my intention to say that NGU solves all the problem of the euro area. My point was that I mean, this potential growth is an important component, and this tool helped the higher debt countries more. But still, no, as you may have seen in the presentation, I was still trying to put some caveats for this type of analysis, especially for the high debt countries. And okay, you have done this model-based. We have also done some model-based analysis, but also the empirical analysis, in which, as I said, still interest rate growth differential in our empirical analysis, which was a sample of euro area countries over various time periods, euro area, not US. Still, we also found that this interest rate growth differential depends on the level of debt, and it's higher at the higher debt levels, but also higher when at a change in the debt level. So a higher change in the debt levels would induce higher differentials. And then there's this controversial chart where we show that interest rate growth differential still remains somewhat negative. As said, this is in a baseline scenario in which we would not have any shocks. So that's necessarily fits the full picture. With some other comments, we also agree. With what Lucrezia said that in an inefficient economy, but also in terms of high crisis, we would have this self-fulfilling expectation, panicking contagion that would need to be somehow tackled, and not always are a picture of fundamentals. But with respect to this wedge, indeed, we also think that this wedge is let's say, much higher for safe assets, for safe government debt. So it's maybe in some countries, but not in all. So we should not also always generalize that the wedge exists irrespective of the concrete country situation. That it is, but say more for the safe debt assets. Then of course there were many other comments related to the endogeneity of the framework of all the variables. We are trying in this framework now, as you said, interest rates definitely would have an impact on growth, and in some of these scenarios to actually endogenize based on let's say responses from general equilibrium model that we put into our framework, like for instance reaction of spreads to a certain to debt path, or reaction of for instance a shock on inflation reflecting also monetary policy response, this leading to higher interest rates and to some growth impact. So in some shock scenarios we are taking account of this type of interdependencies. So I think I stop here for the sake of time.
So we are already a little bit over. Would you like to make a brief remark on the on Lucrezia's argument as a Brunner-Meyer race?
Yeah, I can only agree. So this is basically a very similar mechanism. But there was one remark before, what should we do with interest rate growth differentials are negative. So the alternative to not increasing public debt is that there will be a private bubble that will fill the gap. These private bubbles tend to be less stable, and the profits from that are privatized. Whereas you can try to eliminate that need for a bubble by running, for example, sovereign wealth fund. So I'm not sure whether that will be an issue going forward. The real rates, say on German 30-year bonds, are still negative, and if we expect positive growth, we are still in this bubble territory, but we'll see.
Okay, so I take over as chairman of the session because the compliance officer said that Lars cannot at the same time introduce himself and give the talk. so that would be my, so that's my role now. So I'm very happy to introduce this next session. Our next speaker is Christoph Trebesch from the Institute for the World Economy in Kiel. I'm very happy to have you here. You've worked a lot on sovereign debt, on international financial markets. You did your PhD in Berlin, then you went to Munich, and since then I think you went straight to Kiel. And you already have a fantastic track record, including presence in the media and news articles. So I think we have a lot to learn, so I'm looking forward to your talk.